Air Liquide is built on a foundation of heavy industrial pipes and long-term utility contracts. Yet look at the current share price, and the market is treating this industrial giant like a high-growth tech stock. The data highlights a significant shift. On the left, the price-to-earnings ratio has expanded from a historical average of 24 to roughly 30.5 times trailing earnings. On the right, we see the driver. Over €1 billion in new electronics projects approved just in the first half of 2026. Investors are paying this premium to secure a seat at the table for two specific growth markets: the AI-driven semiconductor boom and the global hydrogen transition. Buying at these levels comes with a specific cost. With the stock trading so far above historical averages, the safety net for new investors has narrowed significantly. To determine if Air Liquide is worth that premium, we have to look past the valuation and see if the underlying business momentum is strong enough to prevent a price correction. The first half results for 2026 show a business operating at a high level, with 4.3% underlying revenue growth and operating margins reaching nearly 21%. CEO Francois Jacot has framed these results as a successful combination of operational performance and dynamic growth during a period of macroeconomic complexity. The catalyst for future growth is the company's €6 billion project backlog. Crucially, half of the immediate opportunities in that portfolio are now tied directly to the electronics sector. While these numbers are strong, they highlight a concentration of risk. The company is betting billions on specific high-tech infrastructure rather than broad industrial diversification. Air Liquide is moving away from the predictable rhythms of a traditional utility and toward the more aggressive, high-stakes requirements of global tech manufacturing. The scale of the electronics push is massive. The €1 billion committed in the first half of 2026 alone is 1.5 times what the company spent in all of 2025. Most of that capital is targeting North America, including over $300 million for new gas facilities in Arizona and Idaho designed to support next-generation semiconductor fabs. Manufacturing AI chips requires a constant, integrated supply of ultra-high purity gases. These specialized facilities are built into the fabric of the semiconductor plants themselves. Growth is also coming through acquisition. In early 2026, the company finalized the €3 billion purchase of DIG Airgas. This single deal doubled Air Liquide's presence in South Korea, making it the industrial gas leader in a crucial global tech market. These investments are already showing up in the P&L, with comparable electronic sales growing 10% in the second quarter. It is this rapid expansion into Asian tech and American AI infrastructure that is providing the momentum for the stock's current valuation. However, there is a sharp operational divergence depending on where you look. While the Americas and Asia are surging, the European and Middle Eastern markets are struggling to maintain pace. The Americas remain a pillar of strength. High demand from refineries and chemical plants along the Gulf Coast keeps these facilities running at full capacity. That stands in contrast to the EMEA region, where turnover actually slipped by 0.2% during the first half of the year. Soft industrial demand in Germany and low utilization of power plants in the Benelux region have created a significant drag on European performance. For now, the high-growth tech regions are compensating for the relative stagnation of the company's traditional European industrial base. Financing this expansion has a cost. Net debt rose to €13.9 billion following the DIG Airgas acquisition, despite the $900 million in added annual revenue. This pushes the debt-to-equity ratio to 0.57, reducing financial flexibility for future projects. This debt is funding complex, large-scale decarbonization projects, such as the 200-megawatt ELYgator electrolyzer currently under development in Rotterdam. Management has staked its reputation on these projects, promising to expand operating margins by another 100 basis points in both 2026 and 2027. With over €3 billion invested in just 6 months, any delay or cost overrun on these megaprojects will immediately threaten those margin targets. External factors add another layer of risk, from geopolitical instability in the Middle East to European helium prices falling to their lowest levels in 8 years. The current valuation leaves no room for error. It assumes Air Liquide will execute these massive capital projects perfectly while navigating a volatile macro environment. Choosing to invest in Air Liquide today depends on your specific goals and your tolerance for the current valuation premium. Growth-oriented investors often see the company as an essential supplier to the AI industry, a way to own the infrastructure of the semiconductor boom. The trade-off is stability versus speed. You get a solid yield and industrial backing, but won't see triple-digit gains like high-risk chip stocks. For income investors, the calculation is difficult. While the dividend payout is reliable, the 30 times earnings multiple is historically expensive. Here, a price correction to the historical 24 times average could wipe out years of dividend income. Finally, those wary of the current economic environment may wait for a clear sign of industrial recovery in Europe before committing new capital. While waiting for a lower entry price reduces risk, it also carries the chance of missing the 15% upside projected by many analysts if the company hits its targets. Air Liquide has successfully integrated itself into the high-growth markets for AI semiconductors and industrial hydrogen. However, the market has already priced in much of that success. This is an exceptional business, but it is currently trading at a price that demands total perfection. Ultimately, you have to decide if the current momentum is worth paying a premium for, or if the safety of a lower entry price is worth the wait.